You could be doing everything right with your money and still be moving toward the wrong financial destination. You save every month. You avoid unnecessary spending. You watch your bank balance slowly climb from $2,000 to $5,000, then $10,000, maybe even $20,000. And every time that number goes up, you feel like you're getting closer to financial freedom. But here's the problem. Saving money and building wealth are not the same thing. Your savings account can protect the money you've already earned, but it usually isn't designed to turn that money into significant long-term wealth. And this is where millions of people get stuck. They spend years learning how to save, but nobody teaches them what to do after they've saved. So they keep piling more and more money into cash because cash feels safe. And safety is important. But if you're keeping money that you won't need for the next 10, 20, or 30 years entirely in cash, you may be giving up one of the most powerful forces available to a long-term investor: compounding. Let's make this extremely simple. Imagine you have $20,000 sitting in an account. That $20,000 has one job right now: sit there. But imagine you also have $20,000 that you know you won't need for decades. That money could potentially have a completely different job. Instead of simply sitting there, it could be invested in assets that have historically provided long-term growth, while accepting that those investments will rise and fall along the way. That's the difference we're talking about. Saving is about protecting money. Investing is about putting appropriate long-term money to work. And you don't need to choose one or the other. You need both. The mistake is treating every dollar in your life as if it has the same purpose. Your emergency money should not be invested like your retirement money. Your rent money should not be exposed to the stock market. But money you won't need for decades doesn't necessarily need to sit completely idle either. So how do you make that transition without putting your financial security at risk? How much should remain in savings? When should you actually start investing? And what should a beginner invest in without turning their finances into a complicated guessing game? That's what we're going to break down. Because the goal isn't to take your savings and suddenly throw everything into the market. The goal is to build a financial system where one part of your money protects you from life's emergencies, while another part has the opportunity to grow for your future. And once you understand that distinction, the path from saving to investing becomes much clearer. The first thing you need to understand is that investing should come after establishing a financial foundation. This is where people sometimes get the order backwards. They hear about compound interest. They hear stories about people becoming wealthy through stocks. They see market charts moving upward over decades. So they decide they need to invest immediately. But if you don't have cash available for emergencies, investing can actually create more stress instead of less. Imagine you have $8,000 invested and only $500 in your bank account. Then your car needs a $2,000 repair. You don't have the cash. You either borrow the money or sell investments. Now imagine the market happens to be down 20% when that emergency arrives. You aren't just dealing with a car repair anymore. You're dealing with a financial decision you were never supposed to make. This is why an emergency fund matters. For many people, keeping roughly 3 to 6 months of essential expenses in accessible savings can provide a reasonable starting point. The right amount depends on your job stability, income, household responsibilities, and personal circumstances. The purpose isn't to maximize returns. The purpose is to buy yourself time. If your paycheck suddenly disappears, your emergency fund gives you room to breathe. And that breathing room protects your long-term investments from short-term problems. Once that safety layer is established, you can start looking at your money differently. Instead of asking, "Where should I put my money?" ask, "When will I need this money?" That single question can change everything. If you need the money next month, you probably don't want it exposed to the same level of volatility as money intended for retirement decades from now. If you're saving for a house you plan to buy soon, that money has a different job from money you're investing for a retirement that's 25 years away. The timeline matters. Your financial plan becomes much easier to understand when every dollar has a purpose. Some dollars are for emergencies. Some are for upcoming purchases. Some are for long-term wealth. And that last category is where investing becomes powerful. Now comes the part that intimidates beginners. What should you actually invest in? You could spend months trying to understand individual companies. You could watch financial commentators debate which stock will outperform next year. You could learn technical indicators, option strategies, cryptocurrency markets, and countless other approaches. But you don't need to know all of that to become a long-term investor. In fact, trying to learn everything at once can make investing unnecessarily complicated. One approach many long-term investors use is broad, diversified index investing. Instead of betting your future on one company, a broad index fund can give you exposure to many companies at the same time. That means one company having a terrible year doesn't automatically destroy your entire portfolio. Diversification doesn't eliminate risk. Markets can still fall. Your investments can still lose value. But diversification can reduce the danger of depending entirely on one investment to succeed. And there's another advantage. You don't have to constantly predict which company will become the next major winner. You're investing in a broad collection of businesses instead. That makes the strategy less about prediction and more about participation. Then there's consistency. This might be the least exciting part of investing, but it can be one of the most important. Let's say you decide to invest $300 every month. That's $3,600 a year. It may not feel life-changing at first. After 1 year, you haven't become wealthy. After 2 years, probably not. But keep going for a decade, and the amount you've contributed becomes much more meaningful. Keep going for several decades, and compounding can become a major part of the result. For example, if someone invested $300 every month for 25 years and achieved an average annual return of 8%, the account would grow to roughly $285,000. The person would have contributed $90,000. The remaining growth would come from investment returns. But remember, 8% is a hypothetical average, not a guaranteed annual return. Real markets don't move in a straight line. Some years can be excellent, some can be terrible, and this is where the psychological side of investing becomes extremely important. Because eventually, the market will fall. Maybe your portfolio drops 10%, maybe 20%, maybe more, and when that happens, the instinct is often to do something. Sell. Move everything to cash. Wait until things feel safe again. But the problem is that by the time the market feels safe again, prices may already have recovered substantially. This is why successful long-term investing is often less about predicting what happens next and more about controlling your own behavior. You don't need to be fearless. You need to understand what you're invested in and why you're invested in it. If your money is meant for a long-term goal, then a temporary market decline doesn't automatically change that goal. In fact, if you're regularly contributing money, a market decline means those new contributions can purchase more shares at lower prices. That doesn't guarantee future profits, but it explains why long-term investors don't necessarily view every downturn as a reason to abandon their strategy. The biggest mistake is investing with a short-term mindset. You put money into the market expecting it to make you rich next year. Then reality happens. The market drops. You panic. You sell. And suddenly, the investment wasn't the problem. Your expectations were. Investing works much better when you give the strategy enough time to operate. Think about it this way. Saving is like building a reservoir. You're collecting financial water so that when life becomes difficult, you have something available. Investing is different. It's more like planting an orchard. You don't plant a tree on Monday and expect a harvest on Friday. You give it time. You maintain it. You accept seasons where growth isn't obvious. And eventually, the thing you planted can become much larger than what you started with. That's what makes time so valuable. You don't need to start with a fortune. You need to start with a system. Build your emergency reserve. Separate short-term money from long-term money. Identify the amount you can realistically invest. Choose a simple, diversified strategy that matches your goals and risk tolerance. Then contribute consistently. And most importantly, don't destroy the plan every time the financial news becomes frightening. Because the transition from saving to investing isn't really about moving money from one account into another. It's about changing the role your money plays. Some money protects your present. Some money prepares for upcoming needs. And some money is given the opportunity to grow for a future that is still decades away. That is the balance. You don't become financially successful by investing every dollar. And you don't necessarily build long-term wealth by keeping every dollar in cash. You build a stronger financial system by knowing what each dollar is supposed to accomplish. Saving gives you stability. Investing gives long-term capital an opportunity to compound. And when those two work together, your money becomes much more useful. So if you're currently sitting on a growing savings balance and wondering whether you're ready to start investing, don't think you have to make some massive move tomorrow. Start by understanding your numbers. Know what you spend. Know how much you need for emergencies. Know which expenses are coming. Then identify the money you genuinely won't need for years. That is the money you can begin thinking about investing. You don't need to become a stock market expert. You don't need to predict the next crash. You don't need to find the next millionaire-making investment. You need a process you can understand, afford, and stick with. Because wealth is rarely built by one dramatic financial decision. More often, it's built quietly. One paycheck at a time. One contribution at a time. 1 year at a time. Saving is where you create the foundation. Investing is where you give your long-term money room to grow. And the real financial breakthrough happens when you stop asking whether you should save or invest and start understanding that you need both. Your savings protect the life you have today. Your investments can help build the life you want tomorrow. The sooner your money has a clear purpose, the sooner you stop simply storing money and start building a financial system around it.